In this series of videos, we are going to use our financial statement analysis knowledge to compare two companies and evaluate them as potential investments, Ashley's Attic and Kadens Closet. We are going to begin by assessing each of these companies' ability to pay their current liabilities. To do this, we will compare both companies on the following ratios: working capital, current ratio, and quick ratio. Once we've developed these ratios, we will discuss some insights that we can draw from these ratios. We can discuss which company is less likely to have trouble paying their obligations. You should think about which calculation would be more important to you and which calculation would be the second most important ratio for you. So these are the three ratios that we're going to calculate. So we're going to calculate working capital, the current ratio, and the quick ratio for each of these firms. So we're going to transition to our Excel spreadsheet here that contains the financial statement information for both firms. So let's just zoom in here. So we can see Ashley's Attic balance sheet, income statement, and other supplemental data. And we can see Kadens Closet balance sheet, income statement, and other supplemental data. So let's begin by calculating working capital. The working capital is going to be current assets minus current liabilities. So current assets for Ashley's Attic is going to be the sum of these three items. And for working capital, we have to subtract current liabilities. So it's going to be the sum of the current liabilities. Similarly, for Kadens Closet, we can conduct a similar calculation. We will add up all of the current assets for Kadens Closet. So it should be cash, receivables, and inventory. And then we will subtract all of the current liabilities for Kadens Closet for 2026. So we get these working capital numbers. Next, we can compute the current ratio. The current ratio is going to be current assets divided by current liabilities. So let's pull our current assets again. So cash, receivables, and inventory, and divide it by current liabilities, which is accounts payable and other current liabilities. So Ashley's Attic has a ratio of approximately 2.12 on the current ratio. And let's repeat this analysis for Kadens Closet. So we see here that Kadens Closet is very similar. They have a current ratio of 2.06. Now we can also look at the quick ratio. Remember, the quick ratio is going to be a little more restrictive in the sense of it's only going to consider cash, short-term investments, and net receivables. So if we look at the quick ratio here, for Ashley's Attic, we will take the sum of cash and accounts receivable. It doesn't look like they have any short-term investments. And we will divide it by current liabilities. So that's the sum of accounts payable and other current liabilities for 2026. Ashley's Attic quick ratio looks like is approximately 1.31. We will repeat the same for Kadens Closet. And we will get a ratio of 1.09 approximately. So with this information, we can return to our discussion here, and we can think about what is going on. So here are the ratios simplified for 2026, and we are going to think about which company is the least likely to have trouble paying their current obligations. Which ratio or calculation do you put the most importance? Why? To you, what is the second most important calculation? Why? So pause the video, take a minute and think about this, and I will see you in the next video.